So now we'll start with valuation of shares. Come to page number 120. This is a very important topic because the same topic is there in SFM syllabus also. Okay. So whatever you will learn in this chapter is also applicable in SFM. So first we will see some golden rules of valuation. Write down in your notebook limitations of valuation or golden rules of valuation. Valuation of share is a very difficult exercise in real life situation because the values are affected by several factors, not just one or two factors, several factors. All factors are considered together to compute the value of the share. So therefore the first golden rule of valuation is an art, not an exact science. Valuation is an art, not an exact science. The reason is not everybody will arrive at the same answer. Is it right? Same company shares, if valued by two different valuers, they may arrive at two different answers, quite different from each other, because they may make different set of assumptions about the company's future profitability, future earning, future cash flow, growth rate, competition, government policies, etc. If it was science, everybody should have arrived at the same answer. If I ask you what is the temperature of this classroom, you'll give same answer. All of you will give the same answer. But if I ask you what is the value of this laptop, somebody will say 10,000, somebody will say 40,000, somebody will say 1 lakh rupees. That is value. Different people may arrive at different answer. So therefore in this chapter also, please remember, more than one answer is possible. Two different students can get two different answers. That does not mean one is right and one is wrong. It is their respective opinions. Is it right? So therefore sometimes more than one answers are expected, as long as you have written your assumptions properly, you have done the calculation correctly, you are going to get the marks in the exam. From exam point of view, practical life, this is a big challenge. There are experts who are involved only in valuation of shares. Point number 2, write down, consideration governing share valuations are varied. Considerations governing share valuation are varied, intricate and numerous. Consideration governing share valuation are varied, intricate and numerous. It means there are large number of factors which affect valuation of shares. Profit, dividend, growth rate, management, government policy, okay, competition, substitute products, assets employed by the company, industry to which the company belongs. Okay, all these factors you have to combine together and then give a value to a share. Point number 3, write down, valuation is affected by opinion, judgment, guess, expectations and bargaining power of the parties concerned. Valuation is affected by opinion, judgment, guesswork, expectations and bargaining power of the parties concerned. If the buyer has a better bargaining power, value will be on a lower side. If seller has a higher bargaining power, the value will be on a higher side. Okay. So therefore, there is no one answer. It depends on situation. Next point, write down. Some degree of subjectivity is virtually involved in all the methods of valuation. Some degree of subjectivity is virtually involved in all the methods of valuation. Some degree of subjectivity is involved in all the methods of valuation. Say for example, you take dividend price approach. Dividend has to be estimated. Present value of future dividend is the value of a share. That is one approach. But dividend has to be estimated. How much dividend the company will pay? Is it certain or uncertain? Or you can use earning yield approach. Value of a share is equal to present value of future earning. But earning is subjective. Discounted cash flow model, suppose you take. Discounted cash flow model, present value of future cash earning. Cash earning future is uncertain. You don't know exactly what will be the cash earning in future. Any method will have some degree of subjectivity. Net asset method involves calculation of goodwill. Calculation of goodwill is subjective. Is it right? Then the next point says no single reliable method of valuation of shares in all situations. No single reliable method of valuation of shares in all situations. According to the nature of the company, according to the industry to which the firm belongs, one will apply the method of valuation. You have to value, for example, Tata Steel, a steel manufacturing company. For them, net asset method will be useful because they have invested huge amount of money in the assets. Is it right? But for valuation of a company like say Facebook, which does not have too many assets, but for them earning potential is important. So you will apply earning capitalization method, present value of earning method. Is it right? So different companies may have different approaches according to their business model. If assets are important, use intrinsic value approach. If earnings are important, use earning capitalization approach. Okay, sometimes a combination of the two can also be used. Next point is several methods or combination of methods are used. Several methods or combination of methods are used. If it is a diversified company, a company has invested in agro business, paper business, food business, hotel business, and cigarette business also. Okay, 5 different verticals, 5 different business units are there. So you may apply different model for different business unit, calculate the value of each business unit, take the total, that will give you the total value of the company, and then divide by number of shares that company has issued. So that will give you value per share. So multiple methods are used for companies which are into different business segments. Next is, why do we need to value the shares? One more paragraph write down. Need for valuation of share. Need for business valuation arises when you have to acquire or sell a controlling stake. Controlling stake means more than 50% of the shares is sold or bought. That changes the control of the company from one person to other person, from the existing owner to the new owner. More than 50% share gives you a right to decide a lot of things. You can pass any ordinary resolution. Any decision have to be taken requires ordinary resolution can be passed by you. You can appoint the CEO of the company now. You can appoint the auditor of the company. You can decide the dividend rate that should be given. You can decide which products should be sold, in which market the product should be sold, what should be marketing strategy, what should be the technology that we have to use, whom we should hire, whom we should fire. Is it right? That is control. You can take almost all business and financial decisions. You can change the whole business culture itself. That is the power of control. That is why people are willing to pay huge premium to get that controlling stake. If the market price of a share is 50 rupees, to get the controlling stake you can pay at 50, say 100 rupees per share also, or 80 rupees per share also. 30, 40, 50, 60% premium over the existing market price may be paid to get the controlling stake, because you don't have to take efforts now. The business is already in place. What you have to do? Just run it again. You are given a existing business. It takes many years to build a business, and that is why premium is paid, right? Next reason why we value share is in a scheme of amalgamation. When two or more companies come together is amalgamation. Absorption, one company absorbs the other company, it has to pay purchase consideration. Merger, two large companies combining their business and now doing the business together is merger. Merger and amalgamation is same. When large entities come together we call merger. Acquisition, you want to acquire more than 50%, 60%, 80% share in a company, you need to value the share. At the time of business restructuring, reconstruction, okay, you may have to sell share, you may have to acquire shares, we need to value the shares. Then banks need to value shares when they have to grant loan to the customer against the share. Especially if it is an unlisted company and you want to take loan, what the bank will do? First get the share valued, and then some percentage of that value is given as loan. Not 100%, 40%, maybe 50%. Some margin the bank will keep in case in future the value is reduced. Still the bank will have enough security. Is it right? Next is conversion of share from one class to other class. You want to convert your debenture into preference share or preference share into equity share, you need to value the instrument to calculate the conversion ratio. You need to calculate the value to calculate the conversion ratio. If suppose the value of a debenture is 1000, value of equity share is 200, the conversion ratio will be 5. 5 share will be issued for one debenture. But if the value of equity share is 500 and value of a debenture is 1000, 2 equity share will be issued for one debenture. So in order to decide how many equity shares should be issued against how many debenture, you need to value both the instruments. Next reason for valuation of share is acquisition of shares of dissenting shareholder. Next point number 5, acquisition of shares of dissenting shareholders. What is dissenting? Those who don't agree, dissatisfied in a scheme of reconstruction. Acquisition of shares of dissenting shareholders in a scheme of reconstruction. Some shareholders do not like internal reconstruction scheme or external reconstruction scheme. They say that we are not happy with the scheme that you have designed. I don't want to lose money. I don't want to get my share capital reduced. What the court will do, court will say, okay, don't agree, sell your share to some other shareholder. Then in order to decide how much amount will be paid to that dissenting shareholder, we have to value the shares. One more point right down, when shares are unquoted, unlisted, okay, privately held companies, they need the valuation more than anyone else. For listed company, price is available in the market. Go to stock market, you can get the price of a listed company. Okay. But for unlisted company, market prices are not easily available. So there the role of valuation arises. If in India there are 12 lakh companies registered under the Companies Act, only around 6,000 companies are listed and traded. Listed and traded. There are companies which are listed but not traded also. So if I only take the companies which are actively traded in the stock exchange, their number is around 3 to 4,000 only. What about the remaining 11,95,000 companies? For them you need to value their shares. Therefore you are required for valuation of shares. Is it right? So when private companies have to sell their business, when private companies have to ask the private equity investor to invest in their company or venture capitalist to invest in their company, they have to get their company valued so that they can demand purchase consideration from the potential investors. Is it right? Nowadays so many mega deals are taking place in the Indian market where they get their companies valued and then they get lot of amount from the investors, especially the foreign investors. Next point, write down article of association or relative agreement so provides. Article of association or relative agreement so provides. Suppose you have raised funds from private equity investor or venture capitalist. They will say after 5 years we will exit from the company. I will provide you funds today, start your business, I will give you 5 years time, and after 5 years I want to sell my shares. Is it right? Then you will have to value the share as per this model. According to that model, the value of the share will be done and the venture capitalist or the private equity investor or the angel investors will be sold or transferred. Is it right? Their shares. So these are the reasons. Practically very important chapter nowadays because business models are evolving and they want their companies to be valued. The moment a company becomes successful, other company wants to take it over. And that time the need for valuation is there. Now write down one more paragraph. Factors affecting valuation of shares. Which factors can affect the valuation of share of a company, that is the business value, are affected by? No doubt assets are very important. You cannot value a company below the asset employed. Can the seller accept a value less than the value of the asset employed? Otherwise it will be better to sell the assets directly in the market and raise money. But you are not selling assets. You are selling a business. A business is much more than a sum of the assets put together. All assets are synchronized. All assets combine together and generate revenue. Is it right? It takes years of efforts to bring a business into existence. And therefore the value of a business should be more than the value of the assets employed. Nowadays business models are changing. Many companies may not have too many assets, but their earning potential is very high. Anybody who owns the shares of the company will get lot of earnings. Okay, if you're owner of a share means you're owner of the earning. So therefore the valuation will be affected by the earning potential, profit potential of the company. Some of the companies whose values are done using this model may be a software company. Is it right? Software companies do not use too many assets. Most of their premises are on lease. Most of their equipments are also on lease. They don't own, but they earn a lot of money. All these internet-based companies, e-commerce companies, their values are affected by their earning potential. They may not have much of the assets. They might be operating from a small office also. Is it right? But the value may be very high because earning potential is very high. So technology company, software company, e-commerce company, okay, telecom companies, the earning potential drives their values. And the next is, don't forget, normal rate of return. That is the required rate of return of the investor. Rate of return expected by investor from a particular industry. This is basically used as a discount rate. Higher the discount rate, lower will be the present value. Lower the discount rate, higher will be the present value. Okay. That can significantly affect the value of a company. In case of large companies like, say, for example, in India, Reliance Industries Limited, TCS, Infosys, if you change the normal rate of return, required rate of return from say 14 to 15%, example, 14% will give one answer, 15% will give one answer. Can you guess what will be the difference in valuation by changing the required return only by 1%? More than 50,000 crore rupees. 1% change in discount rate can change the value of a company by 50,000 crore rupees also. It is so sensitive. This variable is very sensitive and it has to be selected very carefully. Some degree of subjectivity is involved in selection of normal rate of return. For the students of CA final course, this may not be a very, very big problem. It is given. Even if not given, they will give you some hint. Earning per share is 20 rupees, market price is 200 rupees. Normal rate of return 20 by 200, 10%. Practical world is different from theory world. There you have to really go and search for what is the normal rate of return investors expect here. And don't forget, market value of a share is also an important factor affecting the value of a company. If a company is a listed company, market price is 220 rupees since last 6 years, average, last 1 year. Can a valuation expert say that I have qualified CA final, I am a merit holder, the value of the company is 110 rupees only. I am a merit holder, I passed CA final, I passed MBA, I think value should be 110 rupees. Whereas the average price of last 6 months or last 1 year is 220 rupees. So is my theoretical knowledge important here or the market value is important? Market value, when there are lakhs of investor willing to pay 220 rupees to buy a share, any formula that you use in classroom is of no use at that time. People will not accept such valuation report. Is it right? It will be thrown in the dustbin. In fact, if the company is listed and if shares are actively traded, we take average market price of last 6 months or sometime last 1 year, and then the two parties, the buyer and the seller, will bargain for the premium. Is it right? Will bargain for the premium. They will take average price, average is 220. Now buyer and seller will bargain for premium. That depends on what is the percentage of stake transferred. Is it right? If you're transferring say more than 50% share, then maybe the premium would be very high. That if you're transferring say around 26% share, which at least gives you power to block the spatial resolution. 26% also has got importance. With 26%, what you can do? You can block any spatial resolution from getting passed. So you'll pay a premium for that. Or you may get just 20% share. You may just exercise significant influence. Some influence you can exercise with 20% share. You'll pay premium for that. But suppose you only acquire 8%, 5% share in a company. That time you are a minority shareholder, just a normal shareholder. You cannot do much. Is it right? So premium will be again on a lower end. So it depends what percentage of stake is being transferred. Market price plus premium. Okay. Now we will see methods of valuation. So this is our syllabus now, methods of valuation. This chapter is quite open-ended. There is no hard and fast rule that these are the 6 formula and this is what you have to study. Question can come in any form, and according to the question, read it 2-3 times and you design the answer. Wherever in doubt, write assumption. Is it right? Method of valuation, asset-based method. Since in accounts paper asset-based methods are asked, these are also called net asset method, intrinsic value method, balance sheet method, breakup value method. So basic structure of the answer here would be assets minus liabilities. That is why asset-based method. Divided by number of share. Asset की value minus liabilities divided by number of share. This you don't have to write. Page number 120. 120. Next is yield-based method. Yield-based method means we give importance to earning capacity. So here we will apply earning capitalization method. Earnings are discounted to arrive at the value. Or dividend capitalization method. Dividends are discounted to arrive at present value. Okay. If you are going to acquire a large proportion of the share, you prefer to use earning capitalization method because you become owner in the earning. If not today, tomorrow you will get that earning in your pocket. But if you are only acquiring small chunk, few percentage only, then you know that I have to get dividend only. Okay, whatever company pays, I have to receive. I can't do much. So such small investor can use dividend capitalization, whereas big investor can use earning capitalization method. Which method these venture capitalists will use? Earning capitalization method. Some methods are based on what is called market price approaches, like for example, price earning ratio model, where the market price is equal to a certain multiple of earning. Is it right? Earning is multiplied by a certain number that gives the value of the share. That multiple is called price earning ratio. In an industry, there is a price earning ratio. For different industry, there will be different price earning ratio. Okay. Next is what is called book value multiple, where the value is equal to the book value of a share, book value per share multiplied by a multiple. That multiple is called book value multiple. Again, for different industries, there will be different book value multiples. So these are the market related approaches. And then we have one of the most commonly used methods is called discounted cash flow approach, where the value of a business is the present value of future cash flow generated by the firm. And then there is one more method called fair value method. Fair value method is the average of 2 or more methods. It is the average of 2 or more methods. Sometimes one method may not convince you. Then you can use average of 2 methods. Say you are valuing Hindustan Unilever Limited, HUL. So net asset is also important, earning is also important. Buyer and sellers are not convinced only on one method. So what the two parties can do as a compromise formula, take average of two or more methods. So we give weightage to the earning also, we give weightage to the asset employed also. Okay. Now first I will tell you how to calculate the value of a share using net asset method, also called intrinsic value method, breakup value method, or balance sheet approach. Four names to the same approach, because in the exam they can use the words calculate the balance sheet value per share, calculate the breakup value per share, net asset value per share, or intrinsic value per share. Okay. So how to get the answer? We are doing valuation of a business. Buyer and seller both will be interested in market value of the assets employed, not the book values, which are based on historical amounts. Is it right? So wherever possible, take market value or fair value if given in the problem, or if they ask you to value some asset in a particular manner, first you value that asset in that manner and take the market value. Okay. So first you take net trading asset at fair value, that is assets minus liabilities at market value. You are doing the valuation of share now. A business comprises of two types of asset: operating asset and even non-operating asset, non-trading asset. You have surplus money, you invested in government bonds, that you will not consider while doing goodwill valuation. But while doing share valuation, will you also add the investment in government bond, mutual fund and other fixed deposit with bank? Yes, because this is valuation of share, valuation of company. All asset will be considered, whether operating or non-operating. Because if a company acquires your company, they will also get that value, that they will also get bond, share, debenture, fixed deposit and other non-operating asset. Are you not going to charge for them? Are you going to charge it or not? Yes, you're going to charge for everything, whatever you are selling. Add. Then add goodwill also. A business is not just the sum of an asset, sum of the assets. Business is much more than the sum of the asset. A business means all assets combined together are generating revenue. All assets combined together helps in generation of revenue. Therefore, its value is much more than the sum of the net asset, and that extra value is goodwill. Is it right? So calculate goodwill, for which you have four methods, and then that will give you value of the asset. Now what you have to deduct? What you have to deduct? We are valuing equity share. Finally, the asset should belong to equity shareholder. In case if in the balance sheet, liability side, preference share capital is given, deduct. If arrears of preference dividend is given, deduct. If shares are cumulative preference share, deduct arrears of preference dividend if divisible profits are available. The preference holders will not let you sell the companies till you pay their dues. Is it right? So when is preference dividend payable? When the company has profit. So you deduct that. Then you deduct proposed equity dividend. Now here there is a small note. Shares can be valued on two bases: cum dividend basis and ex dividend basis. Cum dividend basis means the holder of the share, the buyer of the share also gets the dividend. Ex dividend basis means the buyer of the share will not get the dividend. So if the problem says value equity share on ex dividend basis, then deduct proposed dividend also, because the company will have to pay proposed dividend. You will not get the dividend. So why will you pay for dividend? Is it right? So value will be less. But if the problem says value equity share on cum dividend basis, then do not deduct proposed dividend. Then the value will be higher, which will include the dividend also. So first the buyer will pay a higher amount because the price of the share will include dividend, and then he will get dividend from the company. So effectively his benefit would be same. Is it right? What student will do? If the problem is silent, we will assume X dividend value, therefore proposed dividend will be deducted. No need to get confused. If you have to value on cum dividend basis, do not deduct dividend. If you have to value on X dividend basis, deduct dividend. In goodwill valuation, never deduct proposed dividend, because there we are not valuing a share, we are valuing a goodwill. So in goodwill valuation chapter, never deduct proposed dividend. In equity share valuation, deduct proposed dividend if shares are valued on X dividend basis. Do not deduct proposed dividend if shares are valued on cum dividend basis. If the problem is silent, deduct the proposed dividend, write a note, shares are valued on X dividend basis. Then next is net asset available to equity shareholders. Final net asset should belong to equity shareholder. That to divide by number of shares. That to divide by number of shares, and that will give you what is called intrinsic value of the share, book value or net asset value per share, or breakup value per share. This means each equity share is entitled to this much amount for every one share. Is it right? For each share, this is the amount he is entitled to. That's called intrinsic value method. Okay. Now, since this is a special chapter, or you are a CA final candidate, some more trouble will be created for you. Okay. They will create some hurdles before you pass the exam. Like for example, they will say there are two types of equity share: fully paid equity share, and there are some shares which have calls in arrear. There are some shares which have calls in arrear. Will the value of a fully paid equity share and the shares with calls in arrear be same? Yes or no? Will the value of a fully paid share and shares which have calls in arrear will be same? No. Which will be higher, valued at a higher amount? Fully paid. Which will be valued at a lower amount? Partly. So there must be some difference between the value of a fully paid share and the value of a partly paid share. So how to calculate the value in this case? What you do, you assume for the time being, only assume that the shares which have calls in arrear will pay the calls in arrear amount. Will pay the calls in arrear amount. Assuming that they pay the calls in arrear amount, what will happen? Your net asset will go up. Assuming calls in arrear amount is received, bank balance will increase, net asset will go up. So add calls in arrear to the net asset already calculated. Now all shares have become fully paid up. So what you will do? Divide by total number of shares. That will give me the value of a fully paid share. That will give me the value of a fully paid share. Deduct calls in arrear. Deduct calls in arrear, and that will give me value of a partly paid share. Is it right? So the difference between the fully paid and partly paid share will be equal to the calls in arrear amount. Why equal to calls in arrear amount? Because anybody can pay the calls in arrear amount, make his share fully paid up, and claim the value of a fully paid share. Suppose the value of fully paid share is 100 rupees, calls in arrear is 2 rupees. So what should be the value of a partly paid share? 98. Because a person who has paid 98, he can pay to the company 2 rupees. So he will move into fully paid share category, and he can now claim 100 rupees. So to get 100, he had to give 2. So the value should be 98 rupees. Okay. Now I'm going to make you write one example so that you are awake, you are alert, you are active. Okay, triple A, alert, active and awake. Example 1. Net asset available to shareholder. Net asset available to shareholder is rupees 4,90,000. Net asset available to shareholder is rupees 4,90,000. Number of shares equal to 50,000. Number of share equal to 50,000 on 5,000 shares. On 5,000 share, there are calls in arrears. There are calls in arrears at the rate of rupees 2 per share. There are calls in arrear at the rate of rupees 2 per share. Yani there are 5,000 shares on which 2 rupees per share has not been paid. So what is the total calls in arrear amount? 5,000 into 2, 10,000. Had you received this 10,000 also, your net asset would have been 5 lakh rupees. All shares would have become fully paid up. 5 lakh divided by total number of share 50,000 will give you 10 rupees, which is the value of a fully paid share. And therefore the value of a partly paid share would have been 10 minus 2 equal to 8 rupees. So write the answer like this. Total calls in arrear equal to 10,000. Value per share is 4,90,000 plus 10,000 upon 50,000 equal to rupees 10. That is the value of a fully paid share. The value of a partly paid share equal to rupees 10 minus 2 equal to rupees 8. So this adjustment will form part of a larger question of 16 mark. Is it right? In a main question when you will solve after some time, this will be a part of a bigger question, same adjustment. So first you add calls in arrear, get the value of a fully paid share, deduct the calls in arrear amount, you will get the value of a partly paid share. Case 2, shares of different classes, different face value. Shares of different face value. Now what will you do? In case of shares with different face value, you will convert them into shares of equivalent face value of one type only. Example, 10,000 shares of 10 rupees, 10,000 shares of 5 rupees. Both are fully paid up. Both are fully paid up, but there are two different types of share. In that case, what you can do, 10,000 shares of 5 each can be treated as equivalent to 5,000 shares of 10 each. Can be treated as equivalent to 5,000 shares of 10. It is like you have 10,000 rupees, 10,000 note of 10 rupees. Is it equal to 5,000 note of 20 rupees? Yes or no? So what I'll do, I'll first convert them into same denomination. 10,000 shares of 10, 10,000 shares of 5 means 5,000 share of 10. The second category will be converted into equivalent number of rupees 10, 5,000. So it will become 15,000 share. Net asset divided by 15,000 share will give you value of a 10 rupees face value share. And value of a 5 rupees face value share will be proportionate amount. Will be proportionate amount. 5 by 10 into value of a 10 rupees face value share. So when shares are of different face value, their relative value will be proportionate. Is it right? Whereas if there is calls in arrear, the relative value will be value of a fully paid share minus calls in arrear. Okay. So now you write one example on this. Write down one example. You have to convert them into one common face value. Either you can take 10 as base or you can take 5 as base. Is it right? Suppose in the given example, write down example 2, net asset available to shareholder is 15 lakh. Net asset available to shareholder is 15 lakh. There are two types of shares you see in this example. Number of shares 10,000 share of face value of rupees 10. Number of shares equal to 10,000 share of face value of rupees 10 and 10,000 shares of face value rupees 5. 10,000 shares of face value rupees 5. So there are two ways you can crack. Either you convert 10,000 shares of 10 into 20,000 shares of 5. Can we do that? Then I will have total 30,000 share of 5 rupees. Or I can convert 10,000 share of 5 into 5,000 share of rupees 10. In that case, I will have 15,000 shares of rupees 10 each. Either of the two you can do. Is it right? Can we convert them into shares of 7.50 also? Unnecessary. Why you want to increase your effort? In that case, you have to convert both categories into 7.5. That answer will be of no use. You have to again convert into proportionate 10 rupee value and 5 rupees value. Is it right? So write down the answer. I'm going to just dictate. First calculate equivalent number of, step 1, equivalent number of rupees 10 face value share. Equivalent number of rupees 10 face value share. Equivalent number of rupees 10 face value share. 10,000 plus 5 by 10 into 10,000. 10,000 plus 5 by 10 into 10,000. 15,000 shares. Is it right? Now write down value per share. In bracket rupees 10 face value. Value per share in bracket rupees 10 face value. 15 lakh divided by 15,000. 15 lakh divided by 15,000. Rupees 100. Rupees 100 is right? Right. This is the value of a share whose face value is 10. Next line, value of a share in bracket rupees 5 face value. Value of a share rupees 5 face value. 5 by 10 into 100. 5 by 10 into 100. Here we will take proportionate value. Here we will take proportionate value. Is it right? So that is 50. This answer is over. Now we'll continue in the next lecture.